Hi everyone, and welcome to bonus lecture of section 11, Discounted Cash Flow Analysis. In this bonus lecture, we are going to cover a case study and calculate the fully diluted number of shares for Restaurant Brands International. Restaurant Brands International, for those who don't know, is one of the world's largest quick service restaurant holding and owns brands such as Tim Hortons, Burger King, and Popeyes. We selected Restaurant Brands International for this study because it has a variety of convertibles, which makes it a great example. Before we start, please go ahead and, like we did in the previous lectures, download the two Excel files I attached to this lecture. You will find the sold and unsold versions. If you want to go over the sold version, this is the sold version, by the way. You're very welcome to do so. However, if you want to calculate all the stuff here by yourself, I think that is even a better alternative as I walk over each one of these steps. So before we start, I want to give you a very brief introduction to this page. Here we have the information we need for this study. Here on the top right corner, we have the fully diluted number of shares summary. Here we have the earnings per share data and calculation. This is because we want to show the impact of fully diluted shares on earnings per share data, which is one of the main reasons why we want to calculate this number in the first place. Here we have some definitions. We have the definitions for these convertibles. If you are not familiar with these concepts, you can just stop the video and read them. I'm not going to read them now, all of them at least. Here we have the directions telling you what we are going to do now. And here we have our calculations of fully diluted number of shares. All right, I want to go over them very quickly. As I said, I'm not going to read all of these, at least not this part. So we have the redeemable convertible preferred shares here, or convertible, which means convertible actually. This is a really big number here. And if you don't know, Burger King, this company is created when Burger King acquired Tim Hortons in 2014. So they financed a part of the deal with a loan from Warren Buffett's Berkshire Hathaway here, and they received preferred shares, almost 69 million preferred shares. We have, as I said, the options here, the list of the convertibles. This is also an interesting one. Probably you haven't seen this one before. This is partnership exchangeable units outstanding. So when Burger King acquired Tim Hortons, they offered some convertible units under the name partnership exchangeable units to former Burger King shareholders, so that whenever they want, Burger King shareholders would exchange this unit to new company's common stock, and it's a 1-to-1 ratio. So whenever a Burger King shareholder, former Burger King shareholder, wants to get the common stock of the newly established company, they will receive 1 unit of common share for each Burger King share they have. And as you can see here, it's outstanding 227 million as the end of 2016 fiscal year. And here we have the current share price, which is a very close approximate to yesterday's closing price, which is 16th of May 2017, and I got this data from Bloomberg. For the purpose of this lecture, I just typed 60, so be aware. And here we have the units, as I mentioned, and we have the exercise prices, the weighted average exercise prices for these convertibles, and here we have the sources. So you can go to Investor Relations page of Restaurant Brands International and check this sources and see the data yourself. It's a good example, I think. It's a good practice, so you would know how the data looks like. It doesn't look like it looks like here, so it's a useful practice. Okay, let's start our calculation now. We will start with stock options, and for the calculation of stock options, we are going to use a method called the treasury stock method. Here we have the list of the stock options. As you can see here, we have the number of shares and weighted average exercise price. These are linked to this part, information part, as you can see. So we do the calculations here actually. So in the money stock options, are found by this calculation. The stock option or warrants become like in the money when the stock price exceeds the exercise price. As you can see here, we wrote this formula and we said if the weighted average exercise price of the stock option is below the current share price, then yes, these stock options are in the money. So in the money stock options are equal to number of stock options because this is weighted average. If not, then take 0. So they are not in the money, they are not exercisable. All right. And we did the same thing for the other stock options here, and we get the sum of these number of in the money stock options, which is 26.2 million almost. And here we have the proceeds. As you can see, the proceeds are calculated by with a very simple formula, which is multiply the weighted average exercise price with the number of in the money stock options. And in total, they are reached almost $500 million. So we know what stock options are. When these guys, the owners, stock options, exercise their stocks, means that they have the right to buy actually company shares at this price. So we are assuming they'll be buying company shares. All right. These are the proceeds to be used to buy company shares. And here, our treasury method calculation, we have the shares from in the money options. This is the total number, as you can see here. And here we are calculating the shares repurchased with these proceeds. And this is the tricky part. As you can see here, this is found by dividing the proceeds. So we know that these guys will have this proceeds, $500 million, when they when they exercise the share price, and we divided it so with the current share price. How many common stock, to find how many common stocks will be repurchased, and that is 8.4 million almost. And to find the new shares from options and warrants, we simply subtracted the shares repurchased from the shares from in the money options and found 17.8 million shares. So from the stock options, and as a result of the dilution of the in the money shares at 60% current share price, we will have 18 million additional stocks. Let's go to the if converted and the preferred shares side. Here, Warren Buffett's convertible preferred shares, 68.5 million, with the redemption price of $48. These are also linked here to our source. And the in the money options, we know they are in the money because this redemption price is below the $60 current share price. So, and let's check the proceeds. The proceeds are also can be found. This is available in the financial statements of the company. When we multiply the redemption price with the number of preferred shares, in the money preferred shares, we find the proceeds. And we use pretty much the same calculation here we have to find the shares from the in the money preferred shares here. And this is 69 million, and shares repurchased, the same logic applies here. We have this much of proceeds, so we have to divide this number by the current share price to find out how many of these preferred shares we are going to purchase, and we subtract it from the shares from in the money preferred shares to find the net shares from preferred shares from the dilution. And here, as you can see, 14 million shares will be created as a result. So we go up to the top right corner to our summary here, and this is the weighted average shares outstanding, the basic number. We got this number from the income statement of the company in its 10K report for the fiscal year 2016. It's an input. We link the number of shares from new shares from stock options and new shares from preferred stocks. We also link this one here. As you can see here, notice we also have these items. This is new shares from partnership exchangeable units. They are not subject to any conditions such as an exercise price. So any former Burger King shareholder owner can go and say, hey, I want to convert this to new company stock. So we just got this number from here, and we add all these numbers to each other to find the fully diluted number of shares for Restaurant Brands International, which is 491 million. And as I said in the beginning of the lecture, we want to see why we are doing this calculation, why it is important to find the fully diluted number of shares. It is important because it can change the earnings per share data. It has an impact on the earnings per share data. Here we have the net income attributable to common shareholders, which is for the year 2016. Again, I got this from the report, $346 million. And we also have net income attributable to non-controlling interest. This is related to this, okay? The non-controlling interest number, if you check the financial report, you will see $340 million. They're not the same. So this is the non-controlling interest of these guys, the owners, all right? Owners of partnership exchangeable units. And when we add these two numbers, we get a total net income of $682 million. For the weighted average shares outstanding, we have the data, which is linked to here, and we have the fully diluted number of shares. Then we calculate the earnings per share for basic shares. We use, as you can see in this formula, the net income attributable to common shareholders. This excludes the net income attributable to non-controlling interest because, as you can see here, we are dividing the net income to common shareholders for the stocks owned by the shareholders. So the common stocks, we are dividing with the number of common stocks basic, and which gives us an earnings per share price of $1.48 per share. And here we calculate the earnings per share for diluted shares, and as you can see here, we include the non-controlling interest here in this case, because we are assuming that these guys, the partnership exchangeable unit guys, will convert their shares and they become a common shareholder. So we have to include the net income, which was attributable to non-controlling interest, but now attributable actually to common shareholders because these guys converted their shares. So we divide this net income, the total net income, by the fully diluted number of shares, and we get a lower earnings per share data because when the shares all convertible in the money options, the convertibles are converted into common shares, we will have more shares and the earnings per share will go down. Alright guys, I think that was clear, and I think in this case the Restaurant Brands International is a really good example for this case study. Alright, now we are literally at the end of section 11, discounted cash flow analysis, and so I see you guys in the next section, section 12, where we'll be covering precedent transaction analysis. I see you guys in the next section.